Good afternoon, everybody. Today is Friday, the 13th of February, 2015, and this is Brian Shannon speaking from alphatrends.net. Hope everyone had a good week here. It was certainly a good week for equities overall as the S&P 500 rose 2% this week. As you know, last week we were up 1 penny year to date last Friday, so obviously all of these gains for the year in the S&P came this week, and same is true for the Nasdaq, which had a good week, up 3.5%. Semiconductors really led the way with 4.5% rally, and oil continues to bounce here, up a little bit this week, but up 10% month to date. So let's go ahead and take a look. We'll look at those bonds, of course, as well, which were down 2%, but let's take a look at the action here on the chart. As you know, we had previously been in this range here where we had seen the lower band of support down in this area and the upper band of resistance up here. And what we were talking about was that we didn't have an idea of which way it was going to break and that we wanted to be cautious. We broke out early in the week and then pulled back, and that was actually that was actually last Friday that we broke beyond that range. We pulled back a little bit, and then on Tuesday, if you saw it on Yahoo Finance, there was a live program at noon Eastern that I was on where I said at noon Eastern, I said it looks like we're headed for all-time highs in the S&P 500. The buyers are in control as long as we remain above this 204 level. I wasn't actually expecting all-time highs here, as quickly as they did come, but the buyers are clearly back in control. We have a new closing high in the S&P 500, and after that arduous first 6 weeks of the year, the buyers are back in control of this market. So it's back to innocent till proven guilty, and what we want to see hold is probably about 207-ish, right around in that area. That's the more important intermediate term level for this market to hold above to remain optimistic about it. So we've got a nice little pattern of these higher lows where we were looking again on Tuesday as this being the important level. Now we'll want to see that this prior little band of resistance holds the support if we get a pullback. So we saw that once we got back above that 5-day moving average here again, and the buyers made that higher high, that it was higher highs and higher lows, and we closed right on the highs today. So obviously the short sellers continue to be the ones who are the most frustrated with this market, and it doesn't mean that there hasn't been frustrations for longs as well. But again, this type of action is why you have to have trading as part of your overall arsenal for being involved in the markets, because you can produce cash flow in that area if you're holding on to some longer term trades that are starting to work out back on the long side once again, and hedge yourself by being able to be more fluent in the market and on different time frames. Again, there's you have to identify for yourself what your perfect time frame is. What I focus on at Alpha Trends and in this commentary really is the intermediate term time frame. To me, that's the ideal time frame to trade on. It gives you the opportunity to make decent gains, and it gives you the opportunity to avoid larger sell-offs and participate in the market volatility in both directions. The Nasdaq this week, we had been focused on this downtrend line, and the fact that perhaps we were starting to become a little bit more bullish because of these higher lows, and we did break that trend line. As I always say, a trend line break doesn't mean a reversal is coming, but it does. In this case, it did in fact signal that, and we saw this higher high. As I had told subscribers that after yesterday, I thought the ideal scenario would be some pullback and test this level, but we're going to remain innocent till proven guilty and look for higher prices as long as that pattern remains in effect of higher highs and higher lows. Again, when I say innocent till proven guilty on the intermediate term time frame, that is a market call. What it means is that I expect this market will continue to move higher. It doesn't mean you can just buy every top tick, but as long as we remain above key levels of support and moving averages, then the market is innocent till proven guilty. And I think for the Nasdaq, I think this is our new bigger band of support that if a deeper pullback comes next week, it's likely to find good support in that area. But shorter term time frames, we'd like to see this pattern of higher highs and higher lows continue. There's no reason to short a market that makes higher highs and higher lows on every single time frame, right down to the 1 minute time frame. It's just foolish to try to fight that momentum. The Russell 2000 is breaking out as well, so that's good to see. We had talked about this market. It was the first to break the resistance, and that we wanted to see this little band of prior resistance hold as support. It did in fact do that. We'd seen that this prior resistance held as support, and then as we broke away from that level here just a couple days ago, and this was the line I had drawn in, that if we get back above that, it put the buyers back in control, and they are in control once again. So now for next week, I think we want to see this level here, basically 120 and a quarter to 120 and a half. We want that to hold as support, and of course we've got that rising 5-day moving average as well. But you can't be bearish on a market that's at an all-time high. As you know, from that failed move came this fast move higher. It's possible that maybe this market's going to break out and then pull right back in as well. We have to be aware of any possible scenario, but wait for price confirmation before we actually participate. So we want to anticipate the scenarios, give the benefit of the doubt to the intermediate term trend that it will be able to continue to move higher. And for the Russell 2000, holding up above 120 and a half-ish is where I think the buyers remain in control. As we saw, the semiconductors had a real strong week here as well. They've had that similar trend line that the Nasdaq had, and we broke this level. I was looking for the possibility that if we pull back, what we want to see hold as support in these semiconductors is down towards this 55 and a quarter to 55 and a half level. If we can hold above that next week, then I think we're in great shape to be able to continue to move higher. So again, it's innocent till proven guilty, meaning expect higher prices, but it doesn't mean if you're an investor, you buy right here, because an investor, where does your stop go? Underneath the most recent relevant higher low, and that might be way down here, and that depends on what your time frame is, how much risk you want to take. If you're a day trader and you came into the day with no position, maybe you bought it as it got back above volume weighted average price with your stop underneath the low of the day and held it through the end of the day. It's up to you to decide your time frame. I can't be all things to all people. When sometimes people criticize or maybe misunderstand is better way to say, they misunderstand that the time frame or the perspective that I'm talking from. It's from an intermediate term standpoint, and that's something you have to figure out what makes most sense to you. If that's your time frame, or if that's something you're interested in learning more about, then go to alphatrends.net and take a 7-day free trial. If you don't like it, cancel, and you'll never be charged. So anyways, the financials had a decent week here as well. As we saw, the financials were up 1.2%, and it's kind of interesting actually. The action in American Express, which is obviously a financial stock, it got obliterated this week. But then you also had a stock like Goldman Sachs, which had a very nice week. So they're even within the sectors, you can't just blindly buy all financial stocks. You can't buy American Express because you think it's down too much, because it continues to be down more and down too much. Now maybe it's getting oversold and it's due for a bounce, but it seems as though American Express has its own unique problems that aren't part of or that aren't affecting at least the financial sector. So for next week, now we're back above and holding above that 50-day moving average. I'd like to see that about 27.10 to 27.20 hold as support in this market. Pulling back down to that would actually be constructive for this market. We're at a we're at this level here where we've seen a little bit of resistance earlier in the week. So perhaps a pullback down towards 24 and a dime to 24.20 would be a good thing, because it would allow this market to kind of refresh after this big rally it's seen here in the last week and a half. That a pullback and refresh would be a good thing for the overall health of this going forward. That is, that we take 2 steps forward and 1 step back. For the oil market, let's take a look at that. I guess I failed to update in last week's video, but we were up slightly this week in oil. As we can see here, the USO up 0.77%, but month to date we're up 10% in oil. And you can see here on this daily time frame that here's this downtrend, and we do have right now this higher high and we can look at this in this area of 47 as a higher low. If 47 holds, then perhaps oil can continue to bounce here, but I really think that it's still early to be able to call with confidence that oil's made a bottom. It's perhaps, I think, the best case scenario at this point is it's in a bottoming process, but no evidence yet that we have a firm bottom. And I like firm bottoms. I think most people do. Anyways, here's the intraday action over the last couple weeks where we saw, here's the beginning of February, and these are 120-minute or 2-hour candles. So, this is that 47 and a quarter level that I think should, that's what we want to see hold in order to consider that oil is, in fact, turning back around. Bonds, as we know, last week started selling off. They're coming down to this prior level of resistance from last year. And we're also, people started buying at the rising 50-day moving average. And as I say, moving averages are a reference point, something to compare price to. They're not a reason to make a purchase. I'm sure a lot of people did purchase here a couple days ago as it touched the 50-day moving average of 129.20, but now they're down $1 on it. What we want to do is look for trend alignment. That is, yes, we have we still have a rising 50-day moving average, and this should still be looked at as a pullback. We'll know, well down the road whether it's the high, but as far as trying to buy it for a bounce, you don't want to buy while it's still making lower highs and lower lows below a declining 5-day moving average. There's no reason to buy the bonds yet. Now, if it can stabilize next week and maybe run up towards 130.5, pull back, hold that 5-day moving average, make a higher low, and then kind of carve out a inverted head and shoulders pattern, and then break that 130.5 level. Perhaps that's a scenario to look for next week. But right now, you still have to look at the intermediate term trend in the bonds as guilty till proven innocent. You don't want to be a buyer of bonds while they're declining. Let's see, what else do we have here? Let's take a look at some individual stocks. Apple had a great week. It broke some near-term resistance from those earnings. We saw that level of 120.5 was broken. The buyers took control and they maintained control. Some people were tempted in trying to short this stock today. I think it's kind of foolish unless you're a very aggressive day trader and you're shorting it while it's below a volume weighted average price for the day and making lower highs and lower lows. Well, then there's day trade opportunities in there. Apple's a spectacularly volatile stock where it trades good volume and volatility, so that there are opportunities long and short for the aggressive day traders. But if you're looking for a top, basically, not to be mean, but I think you're kind of a fool, because the longer term trend is still higher on every single time frame that you look at. We're in an uptrend, and this is maybe a near-term level of support for next week that we want to see hold. But even breaking that, I don't think it would be any sort of disaster. So Apple remains innocent till proven guilty, meaning expect higher prices to come as long as we see as long as we see the levels of support hold and that we have higher lows that are holding based on the time frame that you personally are looking at. So for an intermediate term trader, I think probably at about 125.5. For an investor who's been in it forever, maybe your stop is even way down here. It's personal preference and how you choose to engage the market. Alibaba continues to be a piece of garbage here. It's in a downtrend. It hasn't made a new low, and I think it's likely that it will make a new low, but there remains no reason to be a buyer of Alibaba. You've got plenty of time, because again, if they don't scare you out, they'll generally wear you out. So we saw in the intermediate term that we're seeing it consolidate and move higher a little bit here. It's just a bounce within this bigger downtrend. Nothing to get excited about. Certainly there are trade opportunities on the long side in every single downtrend, but when we have a downtrend, the definition of the downtrend is lower highs and lower lows. The way the math of that works is that you drop 20 points and you rally 15. You drop 40 points and you rally 5. The sum of the declines is greater than the sum of the rallies. So there's more opportunity, plus you have momentum. So why try to fight these trends? It just doesn't make sense. Look at the stocks that have reported earnings like LinkedIn. LinkedIn broke out to new all-time highs highs here, and it's holding on to these gains real well. I wouldn't be surprised at all to see LinkedIn continue to move higher, so kind of in the same way that Amazon has done so after their earnings report, right over in here, the same way that Netflix has after their earnings report. A lot of people look at these and say, hey, they're up too much, I'm going to fade it, it has to fill the gap. Nonsense. People love saying that, oh, I'll buy it when it fills the gap. And not all gaps get filled, or when they do, oftentimes it's 3 years later when a gap will get filled, and it won't matter at that point. So focus on the intermediate term time frames. Perhaps next week above 271-ish, LinkedIn could get going higher once again. And if that's the case, I would say a worst case stop will go down here at about 264. It's at an all-time high, so it's tough to say where it has the ability to continue to go. But as long as it's making higher highs and higher lows on your time frame, then you stick with it and you give the benefit of the doubt to what the trend is. And the trend, for instance, in Tesla, we've had a declining 50-day moving average, and we've seen a couple of rallies above that declining 50-day moving average that have gotten people excited. And as I like to say, it's the direction of the 50-day moving average that's more important than a few days above it. If it's going to turn, the way it turns is it holds the 50-day moving average. The 50-day moving average flattens out, and then it begins to turn higher. Instead, Tesla reported earnings this week, and obviously we know what happened there. It gapped down, and there's no reason to be a buyer of Tesla unless you're a short-term, a day trader. And then, when the stock goes from 193 to 205, it's tempting to think that you can get that you can just buy a good company, whatever that means, when it's down. But look at a gap like this. If you tried that same strategy to buy it on that gap lower, sometimes they continue down, sometimes they reverse back up. But the fact is, the primary trend in Tesla, we have lower highs and lower lows. We haven't broken that pattern. This is the most recent relevant high that we would have needed to break, but we would also need a higher low there. So Tesla's a good one to stay away from on the long side as well. A couple names maybe to keep an eye on next week would include Dish Network, DISH. The daily time frame here broke some resistance at about this 74.5. That resistance was tested and held as support. Looking at a 30-minute time frame, we've had a little bit of volatility here. Let's actually go down to the 10-minute time frame, and here we see the 5-day moving average. We've made a higher high above that 5-day moving average, so I think maybe back above today's high for Monday that it could be a good candidate for a long trade. I would personally put a stop down around in the 76.5, 76, 75 level. Maybe you personally want to put your stop at about $75.80 below this low, or maybe you want to go below the low of the week. There's no perfect way to do it. The perfect way to do it is what is comfortable for you, and to understand what works for you and understand your personality and what you're capable of in terms of patience, in terms of how much time you can commit to the market, and how much money you have to commit, how diversified you want to be. There's so many variables that there's no one size that fits all. You figure out the one that works best for you. Oracle broke some resistance here back in December and has held as support. It's been a little bit squirrely in here lately. I mean, we had this big spike up which failed, and then we broke a lower low with a rising 50-day moving average. So I think that that which doesn't kill it makes it stronger. We got probably in here people who sold short below that 50-day moving average, probably had a lot of stops under there, but it's recovered. And when we look down to the 30-minute time frame, you can see it's been a little bit choppy, but still in an uptrend. So I'd say keep an eye on this one. Be aware of the personality of the stock. By that I mean the personality is that we have strong rallies and strong pullbacks, so be careful about where you buy it. Don't buy it after it's already moved 2 points and get excited. Wait for a pullback, wait for a low volume consolidation, and then look to buy some momentum as the move begins to develop once again back to the upside, and set your stops underneath the level, the most recent higher low that's relevant to you. Don't use random percentages of 3% or 5% or whatever. base your analysis or your decision-making process on what the stock is actually telling you. Another name to keep an eye on next week is Varian Medical Systems. VAR is the symbol here. Clearly in a longer-term uptrend. We had a little bit of a hiccup here in the fourth quarter, and from that failed breakdown came this fast move higher. Now drilling from this weekly time frame to a daily time frame, you can see that we broke some resistance here just in late January, and it's holding up very nicely. It broke on very heavy volume, and it's been, we've seen the volume diminishing as the stock just holds up here. It's not doing anything to the upside or downside, just kind of forming this little pennant in here. And on a 30-minute time frame, here's a level I was talking to subscribers about that I think that we probably need to clear about, this 93 and a quarter to 93 and a half-ish area. If it can do that, then worst case stop down at about 91.70, but I bet you could get away with a tighter stop perhaps. And here you can see I was drawing on this for subscribers that we broke this trend line, but that doesn't mean that it's time to buy a trend line break, because it had already just rallied in this case from 92 and a quarter to 93.10. So you don't buy breakouts that have already moved. Instead, we look at it and say, here's a band of resistance. This is where the stock has encountered trouble the last 2 weeks. That band of resistance, basically from 93.15 up to about 93.35, this is the key level that needs to be broken. So the ideal scenario would be, well, here's a scenario is that it runs up through there, you buy it, and you set your stop underneath this level. The ideal scenario is that it runs up to this level, like this, let's say, pulls back, creates a higher low at 92.75, let's call it, and then it breaks out. That would be the proper place to purchase the stock. That would be the best place to purchase it, because then you would have a relevant higher low at about 92.75 to put your stop under, and you have less risk that way. Or perhaps you put, you buy it out in this scenario, put your stop on half of your position here at 92.70ish, and on the other half you put it way down here. But that, there's all kinds of different ways, money management strategies, position sizing technique, and that sort of thing, and that's up for you to decide what works best for you. Whatever that is, I hope you had a good week, and enjoy a safe long weekend. I'll be back next week and talk to you on Tuesday.